Yes, good afternoon, everyone, and welcome to today's webinar on multifamily properties for beginners. I've been investing in real estate for 12 years, and what I found is investing in multifamily properties as passive investors is one of the easiest way to start investing in real estate for suitable investors. This topic, there's actually a lot to learn, and I had to pick what I can cover in an hour. And while you'll not be an expert after today's webinar, my hope is that you'll walk away with something valuable. So before we begin, I just want to go through the disclaimer. Anything in this presentation is for general information only. Statements and numbers that I use are used as demonstration. Before making any decision based on this presentation, it's strongly advised that you do your own research and consult a professional as needed. A little bit about myself. I started investing in real estate after reading Rich Dad, Poor Dad in 2010, after the financial crash of 2008. I started with purchasing bank-owned homes in California. Over 12 years, I've owned single-family homes, small multifamily homes across 5 states in the United States. I've been investing in multifamily syndications since 2018. I partnered in multifamily deals for over 2,000 doors. I like to continue to learn, so I keep attending more webinars and the programs for learning. I work in tech industry. I live in Fremont with my wife and 2 children. I have an engineering degree, and I am a yoga enthusiast. This is today's agenda. What we will cover today is we'll go through the overview of multifamily properties and the business models used to own them, and then how do they compare with some other investments in a similar space. We'll take a closer look on understanding how multifamily syndications work. We'll go through a case study, and then what to expect as an investor. We'll look at pros and cons of investing in multifamily, and finally the summary. So the first section, overview of multifamily properties. What are multifamily properties and what are the ownership structures to own them? So what are multifamily properties? Any residential building that houses more than one residential unit is technically called a multifamily property. So anything except single family home is a multifamily property. For example, duplexes, fourplexes, and apartment building, these are all multifamily properties. But 2 to 4 unit, that is duplex, triplex, and fourplexes, are classified as residential real estate. And their business model is very different from 5 and more unit multifamily properties, which are classified as commercial real estate. So 2 to 4 unit properties are referred to as small multifamily units. And when we say multifamily, we usually refer to 5 or more unit properties. Okay, let's look at the ownership structures. Let's say a real estate investor, Tom, he wants to buy a small apartment building. He is experienced and he has enough capital, so he can just go and buy the property and own and operate as a single owner. This is a single individual ownership model. Well, let's say if Tom wants to buy a different building, it's bigger than, it's a little bigger, and he has experience owning and operating this kind of properties, but he doesn't have enough capital. So he approaches his good friends Rick and Harry, who are also experienced real estate investors, and they like the deal. They agree to partner with Tom. They all put a part of capital and become partners in owning and operating this property. So these This is a joint venture. In a joint venture, all the partners are active partners. That is, they all contribute actively to the work. Now, let's say Tom, Rick, and Harry together, they come across another deal. It's a big apartment complex. It's underperforming, but with little love and care, it can, they know how to bring it to a level where it will, it's gonna work really well. Now, they have everything, they have experience, but the problem is even together, they cannot come up with enough capital to buy this big of a project. So luckily, Rick knows a few people who are interested in investing in real estate. So he lets them know. And some of them respond, say, hey, we like what this deal. We know this is a good deal and we trust you. So here's our money. We want to invest in this project. And they become investors, or sometimes what is called passive partners. So this model is called syndicate. What syndicate means is a group of people coming together for a common purpose. And here, like, there's different type of people are coming together to buy an apartment complex to get returns on their investments. Now, a syndicate has two types of partners: active partners like Tom, Rick, and Harry, who are involved in every day-to-day business, and Mo, Larry, Curly, or Shempe. Their involvement is limited only to the level of providing capital. They don't have authority to take any decision, or they actually don't have to know much nitty-gritty of the business in order to invest and benefit from real estate. So this way, syndicate model provides a very good opportunity to suitable investors who have money to invest but don't have enough real estate experience to invest and benefit from investing in real estate. For the rest of the presentation, we will focus on the business from perspective of these passive investors. How do multifamily syndicates compare with some other investments? Let's take a look. So we'll look at how multifamily syndications compare with small single family or small multifamily properties, and then how syndications compare with REITs or stocks. So single family homes or small multifamily, one of the big advantages is that as an investor, you are a single owner and you have full control. And whereas in multifamily, as a passive investor, you have no control. This may not be necessarily a bad thing if investing in a deal with a good sponsor who's really experienced, they can actually make better decisions than somebody who's just starting out. Single family homes can be bought using the traditional 30-year fixed mortgage, but that's not available for commercial real estate. Multifamily properties have to be bought using commercial loans. Small single family homes appreciate slowly over a period of time. Multifamily properties are valued based on the income they are generating. So if you can increase the income, the value of the multifamily properties will go up. This is actually a very attractive feature that's used by syndications to create wealth. We'll look at it later in the presentation. Buying one home at a time is a very time-consuming model to scale if you want to make a big portfolio, whereas multifamily is much easier to scale. In addition to that, multifamilies also benefit from higher efficiency by the scale, and they have access to better resources. Let's see how syndications compare with REITs or stocks. So one of the biggest differences is that syndications are structured as partnerships, whereas REITs or stocks, REITs or the commercial companies, listed on the stock market, they're structured as corporations. Syndications are managed by partners themselves, whereas REITs or stocks are governed by a board of directors, which is elected by the shareholders. Now, syndication, when you're investing in a syndication, you have to know that there's no liquidity. Once you make an investment, that money will not be available to you for any other use until the syndication has exited. Whereas in REITs or stocks, you can invest today and take the money out tomorrow. So they are very liquid. Also, another difference is that whereas REITs and stocks are highly volatile, syndications have very low volatility. So their value won't change from one day to the other so drastically. REITs and stocks, you can start investing with even $500 today, and syndications have a minimum investment threshold, which is much higher than that. REITs and stocks, anyone can invest. Syndications, they're only qualified investors can invest, and they require some level of sophistication for investing. Stocks provide no tax benefits. REITs have some tax benefits, but syndications provide much more tax benefits as compared to REITs or stocks. And in syndications, you actually own a slice of property, whereas in a REIT, you own the share of the company that owns the property. Let's look a closer look at how multifamily syndications work. So in this section, we'll look at how syndications work, and we will look at some additional important concepts from perspective of passive investors or limited partners. So remember our syndicate model. Tom, Rick, and Harry, who are involved in business, day-to-day business as active partners, they are also called sponsors or general partners or syndicators. Actually, these terms have slightly different meaning, but from a passive investor point of view, these are all used as interchangeably. Whereas the investors who provide money are called passive investors, limited partners, or sleeping partners, or simply investors. So in order to take a look at how syndicates work, let's ignore them for some time, because they're just their involvement is just to the level of providing money, and rest of the work is done by the active partners or sponsors. And we'll look at some concepts on the related to actual multifamily business model as well. How's multifamily syndications work? Basically, life of a syndication can be divided in 3 stages. First is acquisition, that is the purchase process. Now, once a property is purchased, the focus changes to operation and keeping the property running with efficient operations, and then finding the right time and strategy to exit to maximize the returns on the investment for partners. Let's start with acquisition. So let's take a look at the process, acquisition process. Acquisition process starts when sponsors start looking at deals and underwriting them, scrutinizing them, and see whether the numbers work. And if then for those for which they think numbers can work and they can be potentially a good deals, they are shortlisted and they make offers on them. And if an offer is accepted, then the busiest time for sponsor in the whole cycle starts. They need to put a deposit, the earnest money, which is non-refundable in this case, most cases. They need to hire professionals to inspect building and go through all the records to make sure there are no unknown surprises later on. And they need to work on hiring a property management company, creating legal structure, and securing a loan, and also talking to investors in order to raise the required equity. If everything goes satisfactorily, the transaction closes and the syndication owns the property. Now, let's look at some, they're related to the acquisition process. There's some things that investors should know. Let's take a look. For example, how is the price of the property determined? To determine the price of the property, basically 2 things are needed: net operating income that property is generating, and also the cap rate that's prevalent in that market. Net operating income is simply the annual income minus annual expenses for the property. And cap rate is basically net operating income divided by sale price for the properties that have sold recently in the area. And it's basically measure of how expensive the market is. It's kind of similar to price per square foot in the residential market. If you're familiar with the residential market, it basically measures how much income property will generate for each $100 of purchase price paid for the property when property is bought all cash. Basically takes the financing out of the picture. As we saw, for acquisition, the biggest cost is the actual purchase price for the property, but that's not the only requirement for capital for acquisition. There are other things also. For example, professional fees for due diligence and other transaction costs need to be covered. And more often than not, a syndication will have a value add component. By value add, what's meant is to renovate the units or add some other facilities in order to bump the rents. As we saw, if net operating income goes up, the price of the property goes up. But if that's the plan, the capital expenditures, whatever they need to be done, they need to be planned in advance and included in the capital requirements. Reserve funds. Sometimes when property is inspected during acquisition, it's found that property will need a new roof in 3 years, or maybe parking lots will need to be repaved after 5 years. And that will require money at some time in near future. And that has to be also accounted for, and reserves also need to be planned for. Contingency funds, in addition to everything else, anything unknown scenario may arise, and we need to budget for that. So everything together is added, and this determines how much capital is required for the project. Now we looked at the capital requirements. Let's look at where the capital is coming from. So for a sponsor, the first preference is always to get a bank loan, which is the debt. And because this is the most cost-effective source of capital, but banks won't finance the 100% of the deal. They will typically finance to a ratio. For example, in this case, we are showing 70% of the property value. And the rest of requirement has to be raised by sponsors from investors in form of common equity. Now, this is very typical capital stack. This is known as capital stack, but sometimes you will see some other items like subordinate debt or preferred equity. And it's good to have at least some idea of what those are and how they affect you. Sometimes let's say property requires big capital improvements, and as bank will not provide, how much loan bank is going to provide is calculated based on property's current value. So that may not be enough, and sponsors have to tap some other different sources. For example, they might take another loan from a non-bank entity, and this is called mezzanine debt or subordinate debt. And basically what subordinate means is, in case it comes to recovery, project fails and money needs to be recovered, the senior debt or the bank debt is first in line to recover their money, and then the subordinate debt or mezzanine debt. And then there's preferred equity and then common equity. If you see, this shows the risk and reward profile. Lower in the stack, lower the risk, lower the returns. And as you go high in the stack, as the risk increases, returns also go up. So preferred equity always has lower returns as compared to common equity because they are ahead of line in the risk assessment ahead of common equity. So if you, as an investor, if you are investing in common equity, you should pay attention to this, because if any of these items are present, what that means is in case of failure of project, your chances of losing money have gone up because of them being ahead of you in the line. So so far in this section, we looked at the acquisition process, understood the capital requirement and sources for capital. Now, once the acquisition is successful, sponsors focus changes to optimize the operations and keep them running efficiently. Let's look at that. So in the operations phase, sponsors work takes form of asset management. This is called asset management. And this is called so because as a the property is an asset and it's sponsor's job to keep them running smoothly. So first thing is these properties are managed by property management companies, and property management companies also need to be managed by sponsor so that there are no slacking and they're doing the best they can and they're following all the policies and laws, etc. Sponsors also need to monitor the performance and fine-tune policies according to that. For example, if the vacancy is increasing, they need to drop the rents. This kind of decisions are not taken by management companies themselves. They are taken by sponsors, or some expenses need to be reduced, or in addition to that, they also are responsible for executing the value-add plan in order to raise the rents. They also have some admin, legal, and financial responsibilities. They have to do the financial accounting. They are responsible to meet the legal requirements. And they also make the distribution to partners from the cash flow from operations. And investors and sponsors also look at the investor relations, basically communicating what's going on in project with the investors. So we looked at the operations, asset management. Let's see how net operating income and net income is generated. As we saw earlier, value of the property is dependent on net operating income. And net operating income is annual rental income minus annual operating expenses. Basically, how much cash is property generating before paying for the debt. And once we and from net operating income, we subtract how much loan interest we are paying or loan, and then that is the remaining is the net income, which is available to be distributed to partners after the fees. Sponsors charge asset management fee that will be deducted from this, and then it will be distributed to partners. So net income is the income that is actually available from operations for partners. So we looked at the acquisition process, capital requirements, and sources for acquisition. We looked at the sponsor's role in asset management. Let's look at the exit strategies. So it's a sponsor's responsibility to find the right time and strategy for the right exit, for the exit, so that to maximize the investment efficiency for the project. This can be, so initially when sponsors are seeking capital from investors, they make certain projections of how much returns the investors can make from the property if everything goes according to plan. And this is what sponsors are targeting. Once they think that that projection can be met, they would like to sell the property. Or if it's not the right time to sell property and they've executed the value add plan, what that means is after executing value add plan, the property's value has gone up, so they can potentially get more loan from the bank and return some of the capital back to the investors while still enjoying cash flows from the property operations. But let's say if the sponsor decide to sell the property, then they need to hire a commercial real estate broker, create a marketing package, and then once a buyer is found, they sign the sale agreement and work with buyer to allow them due diligence and make repair as per needed. And then once the sale closes, they figure out the profits and make the distributions to partners as per the agreement. So let's look at some important concepts related to the exit. Sale price, we saw this at the time of purchase. Purchase price was NOI at the cap divided by cap rate, and sale price is same. Profits, whatever sale proceeds, whatever are the sale proceeds from that, loan is paid off, and equity is returned to the investors, and whatever remains is profits, which will be divided among the partners. This equity return is where the investors will get their original investment back, and then they will have a share in profits. Let's look at some other concepts as an investor you should be familiar with. Now, syndicators charge fees. As we saw before acquisition, syndicators already spent quite a significant amount of capital from their own pockets, and they like to recover it once the project is viable. So they charge acquisition fee, and then during operations, to cover their expenses, they charge an asset management fee, and then at the sale time, they charge a disposition fee. These are typical numbers I've seen, but they can vary from 1% to 4%. This asset management can vary up to 2%, and disposition fee also can vary. But as a passive investor, you should pay attention to how much fees syndicators are charging. So we briefly talked about it. What is forced appreciation? Forced appreciation is improving the quality of the asset so that in order to increase the income, and as the income goes up, the property value goes up, and this increases the profits for the investors. This is called forced appreciation, because we're forcing the value of the property to go up artificially. Refinance, we talked about it, this as well. Once the value add plan is executed, property value will increase, and optionally, instead of selling at that time, sponsors may refinance, return part of the capital to investors until a suitable time for exit is found. Profit split, very important to understand. So as we saw, there was net income generated from operations and profit from sale. So how is it divided among general partners and limited partners, or how is it divided between sponsors and investors? So there's agreement while raising the capital. The sponsors will tell the investors what is the profit sharing scheme, and simplest of that is straight splits. What that means is every dollar of income created by the syndication is divided in a fixed ratio. 80% goes to the, for example, like if it's 80-20 straight split, 80% will go to the investors and 20% will go to the partners. Now, sometimes in order to boost returns for investors, sponsors will offer what is called preferred returns. And basically what this does is it gives boost so if, for example, let's say there's 8% preferred return, what that means is until the investors achieve their at least 8% return on their investment, the sponsors will not get any money from the profits or income. And once that 8% target is achieved, any money made by the property after that will be divided according to, if there's a straight split, according to that, like, according to the split ratio. For example, let's say the property made, let's say, $10,000. So first 8,000 will go to the investors, and the rest of the $2,000 will be split between sponsors and investors as per this ratio. Then there's water flow. Water flow is used by sponsors to reward themselves if the projected targets are achieved. If property does really well, let's say, in the marketing material for investors, sponsors projected 15% returns for investors. And let's say property does really well, and investors easily achieve 15% returns. So any money left after investors achieving 15% return will be split according to a different ratio. For example, up to 15% after preferred return until this ratio, they will be split according to a certain ratio. And once the target return for investors is reached, sponsors may choose to share higher percentage of the returns. Return metrics. How is the performance of a property is measured? These are the common metrics used to measure the performance of a property. Cash on cash returns, equity multiple, average annual returns, and internal rate of return. Let's look at it. Cash on cash returns is basically annual cash flow divided by their original investment. And this is basically a snapshot. It's not used for total returns. It's used for, like, in a year one of the ownership, how much returns the investor made for the property. Year two, how much return the investor made. So cash on cash return is different for each year. Cash on cash returns is usually used to measure, like, to how much income is property generating during ownership. Equity multiple is total income produced by the property and plus profits generated from sale divided by original investment. It doesn't take time into account. Like, even if the same returns was generated by the property, same amount of money was generated for the investor by property in 10 years or 5 years. In each case, equity multiple will be same, but assumption is that equity multiple is calculated over a period of 5 years. So, but that's not a universal rule. So if you are comparing two properties using equity multiple, it's good to pay attention over what period the equity multiple is being calculated. Average annual returns is used to actually measure how much total return property generated over the ownership. So total cash flow generated by the property during the investment, and the profits from sale divided by original investment, also divided by the number of years owned. So then there's IRR. IRR is basically internal rate of return. It's like ARR, average annual returns, but it also takes into account the time factor when the returns were received. For example, if the returns were received earlier, investors could potentially reinvest it and make more money. So it takes that into account. It has complex formula, and it calculates total returns. So even though formula is complex, but it can be easily calculated in Excel or Google Sheets using, they have built-in IRR calculation function. So this is just an example of how AARs and IRR is different. For example, let's say $100,000 are invested in a deal, and year one, no returns. Year two, no returns. Year three, no returns. Year four, no returns. And year five, $75,000 income is received in addition to the original 100,000 investment. In scenario two, investment amount is 100,000 again, but year one, $75,000 income is received. Year 2, 3, 4, 5, no income is received, but at the end of the year 5, original amount is received. Now, in both cases, at the amount of $100,000 investment, $75,000 was received as income in the same duration of investment. So average annual return in both cases is 15%. But in this case, in scenario 2, the investor could have taken $75,000 income and reinvested and made more money on top of that. So IRR takes that into account. So that's why you see IRR is drastically different. It's a huge difference in IRR. So we looked at how syndications work, how the acquisition process works, what are the capital requirements, sources for capital, how are the operations run, the role of sponsors in asset management, and then what are the exit strategies and some additional key concepts. Let's look at a case study to reinforce these concepts. Let's say there's a property with number of units to 200 unit apartment complex. And on average, these units are rented for $750 per month. And the property is incurring $840,000 of expenses per year. And the prevalent cap rate in the market is 6% interest rate. Bank is offering 5% with interest only option. So the total annual rent for the property will be 1.8 million. And subtracting the annual expenses, we get net operating income of $960,000. So the purchase price for property, a good purchase price for property, or I should say fair purchase price for the property in that market, will be 960,000 divided by 6%, and we get $16 million. Planning for reserves and contingency funds, let's say $400,000. Funds required for acquisition is 16.4 million. Now, how is this equity raised? 70% of the value, so 70% of 16 million, not 16.4, because property is appreciated as 16 million. So 70% of that is provided by bank, and rest of the capital is raised in form of common equity from investors. In order to raise this amount, sponsors offer 5,200 shares in the partnership, each share for $1,000, and they offer 70-30 straight split profit sharing scheme. Mo buys 100 shares of investment for an investment of $100,000. So looking at the baseline, when we bought the property, the annual income was 960. The net operating income was 960,000. And the loan payment now is $560,000 at 5% of the loan amount. So the net income when we purchased the property was $400,000. So this is how we got the net income, and let's see how it changes over the years. Over the years, in a good market, it's fairly, I mean, it's very fair to assume a 3% of rent increase every year. And even though expenses grow a little slowly, but let's just assume 3% here, and 5% is interest rate. So rental income goes up by 3% every year. Expenses go up by 3% every year. Net operating income also increases in that, in line with those increases. And after paying the interest, net income this is our net income. This is the baseline. This is what numbers look like when we purchase the property, and this is how the net income has increased from year 1 to year 5, from 428,000 to 552,000. So what do investors get out of that? Our Mo, let's look at that. So net income for in year 1 was 428,000, and sponsors charge 1.5% as fee. So taking that fee out, this is the cash flow which is available to be distributed to partners. Applying 70% for investors, we take 70% of cash flow. This is the amount that goes towards investor, and rest is distributed to the sponsors. Out of this, because of the total $5.2 million equity, Mo had invested 100,000. So this amount divided by 52 will give us the Mo's income in first year. And Mo made a cash on cash return of 5.69% on his 100,000 investment. And then year 2, year 3, similarly, his cash on cash return along with the income goes up. Let's say at the end of year 5, when our net operating income is $1.1 million, sponsors decide to sell the property. So net operating income divided by 6%, this gives us the sale price for the property. This is the sale price at which property is sold. So out of this 18.5 million, 11.2 million was the loan payable to bank, so that amount is returned to bank. and 5.2 million that was raised from the investors, their original amount is returned. That's where Mo gets his original $100,000 back, and remaining profit out of the 2.1 million remaining profits, 3% disposition fee is charged by sponsors. Rest of the profits are distributed according to the agreed upon profit split share. 70% goes to investors, and Mo gets 1/52 amount of this, which is 21.43, sorry, $21,000, and his return on from sale only, he made 21%. So this shows how much Mo made from the whole project, syndication project. Year 1 to year 5 cash flow, and then the proceeds from sale. Now let's consider what would happen if the sponsor had actually planned to increase the rent to bring it to par to the surrounding properties, which are renting for $900 per month. First of all, they would have to, even before acquiring, they would have to budget for the value add expenses, estimating an average of $8,000 per unit renovation costs. For 200 units, it will be 1.6 million. Adding 400,000 for reserves and acquisition, that the total acquisition cost is 18 million as compared to the original 16.4 million. And then because bank will only fund based on the property value, purchase value, which hasn't changed, or rather property value. Rest of the increase has to come from the more equity raise. So instead of 5.2 million, now sponsors need to target to raise 6.8 million of equity raise. Let's say Mo still invests same $100,000 in the investment. His share in the equity is 1/68 instead of 1/52 in the original example. This is how his this is the net income. So this is how the numbers look. Rest of the assumptions are same, and net operating income and net income, they will be different, but you need to pay attention here, like year 1, because when the renovation is going on, for renovation, the units have to be vacated. So the vacancy will go up in year 1, and that means less rental income. But the good news is year 2, the income significantly goes up because the renovated units are now renting at $900 instead of $750 per month. And then for rest of the duration, they still continue to go on with market 3% per year. So let's look at what it changes for Mo. So applying same calculations, Mo's return in first year is low, 1.98%, but then it goes up to 7%, 7.19, and eventually until year 5 when he gets 8.38% cash on cash return. After 5 years, the property is sold. So net operating income at the end was $1.38 million as opposed to $1.1 million. And sale price, instead of 18, because of the increased NOI, the sale price has gone up, significantly up. And the equity is returned. Of course, that number will be different, and profits will be higher. Instead of 2.1 million, now the syndication made $5.1 million of profits. Taking disposition fee out and distributing according to the profit sharing agreement, Mo makes 45.45% in this case. Compare that with the organic appreciation. So this is how Mo's returns change from organic appreciation to forced appreciation scenarios. Overall, average annual returns in first case were 10.78%. Post appreciation, the average annual return was 15.71%. Here are the other metrics we talked about. Average annual return, equity multiple 1.54 in this case, 1.79 in the post appreciation case, and IRR is 9.92% and 13%. So what to expect as an investor? So we talked about how what is the role of sponsor in the purchasing and managing or exiting the property. Let's look at what you can expect as an investor. Give me a minute. So first of all, let's see who can be a passive investor, who can invest in these opportunities. Unfortunately, not everybody can invest. They have to be qualified. The most common way to qualify is as accredited investors. There are certain net worth or income requirements that investors have to meet. Actually, basically, investors have to have either 1 million of net worth or $200,000 of annual income if single, or $300,000 of household income if married. There are other ways to qualify. For example, if you work in financial industry, and you can go to SEC site to learn more about it. In some deals, in addition to accredited investors, they also accept some limited amount of sophisticated investors. And sophisticated investors, what basically it means is these are defined as by SEC as the investors who have sufficient knowledge and experience to understand merits and risks of such investments. So what does a passive investor do? What a passive investor needs to do to get started before actually making an investment? First of all, they need to learn. They need to learn as much as they can. An educated investor is a good investor. And there's a lot of information available out on internet, on YouTube, and everywhere. So if this is something you think you would like to do, then just start learning. Then understand advantages and risks. Identify syndicators you can trust. I mean, there are a lot of syndicators out there. Not everybody will match your wavelength. I mean, at the end of the day, before picking a syndicator, you need to feel that you can trust them with your money, and then they can execute. They can execute the plan. Then get on their syndicators list of qualified investors. You will have to talk to them. They will call you. They will ask you certain questions to get to know you, and they will qualify you whether you are suitable or not. And once you're qualified, they will add you to their list of investors. And when they have deal, they will send it to you. At that time, you can look at the deal, scrutinize, and see whether it makes sense to you, if you would like to invest or not. If you don't want to invest, there's nothing you need to do. But if you like to invest, you can let them know that you would like to invest, and they will ask you to fill out a paperwork, and then you can transfer the money, and you're done and ready to enjoy the passive income. So after making an investment, you can enjoy your passive income, but it also pays to stay informed, because sponsors send communication regularly. At least good sponsors do. And it's a good idea to read those to inform yourself what's going on. And this is also a very good way to learn. And read reports about the property and what's going on. Ask sponsors a lot of questions so they know that you're paying attention. And also, again, a good way to learn more about business. Let's look at pros and cons of investing in multifamily. So some of the best opportunities in real estate are found in commercial real estate. And syndications provide a way to access those even with limited real estate experience. And they have typically high returns by industry standard. As we saw, they have low volatility, tax benefits. They provide passive income. They have built-in liability protection. So as a passive investor, you are not exposed to liability because you are not actually doing anything. Whereas if, as a single family homeowner, you are exposed to liability issues. Anybody can sue you if something is So this is a big advantage investing passively, especially for new investors. Easy to diversify. I mean, you don't have to pay the full acquisition cost. As a passive investor, it's not your job to arrange the money for the whole project. You can choose whatever amount you want to invest after a certain minimum threshold. And actually it's a good idea to spread your capital across multiple projects, across multiple sponsors, in order to minimize your risk. And another big advantage of investing in multifamily syndications is that they are really good inflation hedge. Cons of investing in multifamily syndications passively. Biggest con is that these are illiquid investments and period is sufficiently long. The investment period is like 5-6 years typically. So before investing, you need to think about that and make sure that you will not miss that money during that period of time. Only qualified investors are allowed to invest. As we saw earlier, accredited, or you have to be accredited investor or sophisticated investor in order to be able to invest. High investment threshold. Typically, there's a higher investment threshold as compared to stocks or REIT, as we saw earlier. Typically, minimum investment amount is $50,000, but there are sometimes lower, like $25,000, but more often than not, you will see like minimum amount $50,000. You have no control. We already talked about it earlier. Highly dependent on sponsor performance. Sponsor performance highly dependent on sponsor. Sponsor can make or break a deal, irrespective of how good or bad it looks. An experienced, good sponsor is very crucial for the success of the project. Change in market conditions. So market can change anytime and things can change drastically. This not only applies to multifamily syndications, this applies to pretty much any investment, be it stocks or real estate or even savings. So that's always a risk. Capital call. If anything changes in the project and project starts failing, you might get a capital call. Capital call means that sponsors decides that in order to keep the project going, they will need more money and they reach out to investors. And if you want to keep your original share in the project, you need to provide more capital in the same ratio. And if you don't, your share in the equity will go down. So that is always a theoretical possibility. It doesn't always happen. But yeah, you should consider that. More complex taxes. This is usually not an issue if you get taxes done by a CPA, but if you do taxes yourself, you have to know that you will get a K1 partnership K1 during the tax season, and it can be daunting for someone who's not well versed with tax codes, or if you're not very comfortable with that stuff. So what did we learn today? We took a look at what multifamily properties are. We compared them with some other investments. We took a look at how multifamily syndications work, and we saw a case study, what to expect as a passive investor, and what are some of the pros and cons of the investing. Since we have a couple of more minutes, I want to just show this slide. And this is my first investment I made in 2018. And this concluded this year, this exited this year. This was my original investment amount. And this is what I got over a period of 3 years, including the original amount. And this is my list of distributions. Every quarter, there's 8% of cash flow, except the first quarter of 2020, when due to pandemic starting, it was suspended. And this is when they exited. And even though its equity multiple says 2.6, it's not really accurate, because it should be actually, because the investment duration was only 3 years instead of 5 years. And this was IRR and average annual return. So this was really good investment. This is not typical, but I just wanted to show you my first investment. So we will go into question and answer, but before that, I just want to show where you can reach me. If you have questions after the presentation, feel free to reach me. Here's my email and website. If you want to learn more, you can check out my website later. I'll be adding more learning resources there. And before we go into question and answers, I request some feedback on how much you like the webinar. Please fill in the poll. I will really, really appreciate that if you do. Okay, and this is the time for questions and answer. I'll take questions at this time. So what is the process to become an accredited investor? Well, there's no process to become an accredited investor, whether if you meet the net worth or income requirements, then you are an accredited investor. Only thing is you need to prove to the sponsor if you want to invest. And different sponsors have different process for that. Nowadays, it's become very, very standard to have a third party who actually specialize in this. They will ask you for proof of your net worth or income, W-2, whatever way you want to qualify. And after that, they will provide a certificate that they have checked and you are a qualified accredited investor, and you can use that certificate anywhere with any sponsor you are investing with. Okay, where do I find these indicators? What is an average AAR? Well, you can find these indicators everywhere, actually, online. You can actually get on my mailing list. I'm looking at deals now, and join the meetup group that I have, and you will learn more. And you can talk to me offline. I don't want to give recommendations online, and we can chat about it. Okay, well, no more questions. I'll wait for a couple of more minutes if you have questions. How does people invest as independent individual or an LLC? Well, the people invest both ways, but specifically for investing in passively into syndications, you don't need to form an LLC. You are protected. There's no reason for you to create an LLC to invest in a syndication. What's the benefit of syndicate over S&P 500? They are very different investments. I would say S&P 500 average return is 7% is what industry standard is. I can tell you that syndications have much, much higher average return than that. And then they have tax advantages, which you don't have investing in stocks. But having said that, each person's scenario is different, and you need to consider your situation and then make up your mind. What are the tax advantages of this investment for an individual? Well, tax advantage is number one. In any real estate project, you have depreciation, and depreciation usually shields your income from the project. And these are structured as partnerships. Now, in what happens is in a company, a corporation, the corporations pay tax on the income, and then what dividend you get, you pay tax on that dividend. So it's double taxation. In case of partnership, it's a pass-through entity, so they don't pay any taxes. So that's one advantage. The other advantage is depreciation shields your income. And currently the government is allowing bonus depreciation. What that means is 100% of your investment can be depreciated in year one. And not only that will save your current income, but you can actually use that to offset some other capital gains you might have in stocks or anywhere else. If you have really big gains, that may be something very useful. But at the end of the syndication, you will have to pay taxes on that amount. But what happens is, if you can do 1031 exchange, you can avoid that, and you can continue to avoid that till forever, until you pass away. And at that time, that is the advantage of 1031. Basically, your children will inherit, and that will go, the tax liability on that particular asset will go away. Are syndicators recession proof or a house market crash proof? Well, it's very often cited that in 2008, when housing market crashed, multifamily market did really well. And what happens is, because people who otherwise would have bought a house, they are not able to buy houses, so they actually rent. So actually rents go up. This is what we are seeing currently also, at least in some markets. But there's no way to tell that future recessions will be similar or not. Are there differences state-wise? Yes. I don't know in what respect, what kind of differences. Maybe you want to clarify, because I'm not clear what kind of differences. I mean, some states are more business friendly, and some states are more business friendly and are growing markets, whereas some states are losing residents. You don't want to invest there, because when people are leaving, you can think like, rents will not go up in that market. Is current inflation help investment now? I believe inflation in an inflationary scenario, this kind of investments are really good. You have to be careful in picking the market where you're investing. Invest in a growing market, Texas, North Carolina, for example. Yeah, I mean, it's good. Is California good to invest in syndicators? I do not invest in California. I do not recommend investing in California. And in Bay Area anyway, specifically, like, cap rates are so low, you cannot make money. See, what happens is, if the cap rate is lower than the interest rate you're paying to bank, that means property is making less money than you would pay on the same amount to bank. So it does not make sense to take loan and buy a property. And without loan, I mean, it's hard to buy, a property, because these are expensive assets. As a passive investor, what are the criteria to exit early? You cannot exit early. You mean, I'm not sure I understand the question. Once you make an investment, I don't think you can leave the investment until the exit comes. But if your question is, as a passive investor, what are the criteria that investment will exit early? Well, as a passive investor, you don't take that decision. That decision is taken by the sponsor, and sponsor will see if they promise like 15% to investors, and they had their certain returns themselves in mind, and selling today instead of 2 years later can help them meet those projections. They will sell it today. Is it possible to see off your shares in a syndicated real estate investments? Is it possible to see off your shares? I'm not sure I understand the question, Jishan. Should we choose democratic state? Which states are better to invest in? Well, Democrat or Republican, I don't want to go there, but the business-friendly states, you should invest in business-friendly states. And Arizona, Texas, Florida, North Carolina, these are some examples. Georgia, Florida, you have to be a little careful where you're investing, because at least I am a little careful investing in Florida, because there's a lot of activity going on there. There are some really good markets, a lot of people moving there, but I'm not sure about climate, how that affects in future. Is it possible to? No, it's not possible to sell off your shares in syndicated real estate investment before. No, there's no market for that. You can talk to sponsor, and if they can find somebody who's willing to take off your shares, they might, but I won't count on it. What are some of the trustworthy syndicator brands? I'll say talk to me offline. We can talk about it. Any more questions? What's usual percentage of syndicators going under the water? I don't know. I have like some published statistics on that. And I heard some examples here and there. Like I heard somebody took investors' money and ran away. But in the circles I interact with, I haven't met anyone. I mean, you have to, that's why you have to know that you're talking to a genuine real estate businessman and not a con. I do not know any example where actually they went underwater. I mean, I know of some investors, some sponsors, they actually put money from their pocket in 2008 crisis. And at that time, I'm sure some might have failed, but I don't know any. Any more questions? Welcome. Okay, well, how often are the returns paid? Yearly? Well, it varies from investment to investment. Some syndications pay quarterly. Quarterly is the most common. Some pay monthly. If they pay monthly, the returns will be slightly lower because it can be the admin expenses increase a little bit because of having to process that every month. I have seen a couple where it was paid yearly, but I don't see those very often. Do indicators indicate when the exit will be? What's the number of years for exit? Well, typical projection is for 5 years. And in last few years, I've seen most are exiting very early, like syndicators who started in syndications that started in 2018 to 2019, because last couple of years have been extraordinarily good. So they achieved their numbers much ahead of their time. But typically it's 5 years, but if in the 5th year, let's say, if the market is not good, they might extend for a year or 2 years more. So whatever they project, they always project some number of some duration, but that can change a little bit. Okay, any more questions? Well, I want to thank you all for your time. I hope it was useful, and I look forward to see you in more meetups in future, and have a wonderful rest of the day.